Welcome to Wealthion. I'm Wealthion founder Adam Taggart here, welcoming you here to something a little bit new. We are launching a new segment on the Wealthion channel right now, which we're calling creatively Weekly Market Recap. And it's exactly what it sounds like, just sort of a post-game analysis of what the markets did this week. I am joined by Lance Roberts. Hey, Lance, how you doing?
I'm good. How are you?
I'm doing great. Well, Lance, I'm super thrilled you're here for me for the inaugural weekly market recap. You and I will be doing this hopefully weekly going forward if folks like this new format. I announced last week on this program that your firm, RIA Advisors, has just joined Wealthion as one of our endorsed financial advisors. Super excited to have you on. I've had lots of great feedback from folks about that announcement. But one of the things I really respect about you and your firm is you guys are great capital managers, but you are also real students and scientists of the markets themselves. And you produce a ton of content during the week, analyzing, reacting to, articulating for folks to help them understand what's going on sort of on a play-by-play basis for the markets. And so I'm really excited to bring that intellectual firepower to folks here in these weekly market recaps.
Hey, well, we're glad to be here. And, that's because I have no wife that we produce all these charts.
Well, I'm sorry to hear that for your sake, but selfishly glad that we get to just suck all of that from you. So let's jump right off here. So we'll kick off these segments with sort of a theme of the week. What is the theme of what the markets have done this week?
Fed.
Fed. All right. Gosh, I feel like we might have that theme a lot going forward, but okay.
Yeah, but no, it really is. This earlier this week, I was on Fox Business with Charles Payne talking about this very idea, and he brought up a very interesting old Police song, talking about the master and the slave. And he asked me the question. He says, "Well, who's really the master and the slave? Is the market slave to the Fed, or is the Fed the slave to the market?" And it's a really good question because, if you think back over the last year in particular, what's been the primary argument for a highly overvalued market that just kind of kept going up? It was the Fed, right? So as long as the Fed was doing $120 billion a month in liquidity, why not just take on all kinds of risk, buy AMC and GameStop and, any type of meme stock that came on. Fundamentals don't matter. It's all about liquidity in the Fed. So, at the same time, the other side of the argument is that, well, the Fed will never let the markets correct, because if the markets fall down, then you lose consumer confidence. That impacts the economy. So maybe the Fed is actually slave to the market. It's a very interesting marriage that we have going on between the Fed and the markets, because really they are both held hostage by each other. And the question is really ultimately who is going to blink first. That's going to be the big question. And that'll be the question I think we'll see answered this year, with now the Fed minutes earlier this week. What caused the sell-off earlier this week? And I do want to touch on that here in a second. But what caused the sell-off earlier this week? Well, that was the release of the Fed minutes, which was a lot more hawkish than what the Fed had originally kind of alluded to. The Fed was saying, hey, we're going to hike rates sometime in June, and we're going to taper the balance sheet by $15 billion a month, and it's all going to kind of work out really nice and everybody will be happy. Well, the minutes come out from December, and all of a sudden we're talking about a March rate hike, and we're talking about rolling off the balance sheet even faster. The market was not ready for that. So again, we had this correction earlier this week. And the Fed is now in a really tough box. This employment report today that came out on Friday was much weaker than expected. They were expecting over 400,000 jobs. ADP had reported a much stronger number than that. And the job report came in about 199,000 jobs. While the report was weaker on the employment side, what was interesting about that report is that wage growth grew in line with inflation. So you're still seeing very sharp rises in wages. That puts the Fed into a tough box here, because the Fed has got to really run monetary policy based on inflation. And that increase in wage pressures is certainly an inflationary pass through the economy. And that is going to impact profit margins. That is going to impact economic growth down the road. And the fact that wages aren't keeping up with real inflation is going to impact consumer consumption later on this year. So I'll shut up now.
Okay. No, that's great context. And I'm so tempted to get into my regular macro mode that I do in my normal interviews. I want to make sure we keep this one about the market action, what happened this week. So I'll be brief here as well. But so basically, kind of key development this week, the Fed, or the Fed minutes, sort of surprised the market because they show that the Fed is even more aggressive than what the markets were led to believe by the end of last month. And I just want to make sure I have my math right. The Fed had been putting $120 billion into the system monthly for a long time, and said, we're going to start tapering that. We're going to take maybe 15 billion off a month as we do our gradual taper. Then a few weeks back, Powell said, now we're going to accelerate that. We're going to do maybe 30 billion a month. But if they are going to hike rates in March, they kind of have to get through whatever they have left in the next 2 months, right?
Here's the thing that's important about what you just said is that, yes, they are tapering faster. What the market is, and this is the interesting part about the market. Okay, so what was the argument over the last 2 years? Don't fight the Fed. The Fed is liquefying the markets, buy stocks, markets are going up. Now, the interesting change to the commentary by the bullish commentators are, hey, fight the Fed. It doesn't matter that they're taking away the liquidity and hiking interest rates. Stocks should do just fine because the economy is really strong. You can't have it both ways. You cannot have an overvalued market that is justified by low rates and lots of liquidity, and then say you can have an overvalued market because you've taken those things away. That just doesn't work that way. And the aggressiveness and the speed at which the Fed is now talking about tapering and running off their balance sheets, I think will have an impact on these higher risk, higher beta names in the markets. And look, we're already seeing it now. While you may look at the index and say, well, the S&P is only down a couple of percent from the peak. It's sitting right on the 50-day moving average. This correction this week was really, kind of normal. It's pretty much the same thing we've seen over the last year and a half, where we have these retest of the 50-day moving average. We get a rally to new highs. We kind of consolidate sideways, and then we sell up to the 50-day and wash, rinse, and repeat. And that has been the case, except underneath the surface, and particularly if you look at the NASDAQ, you have a record number of stocks that are down 50% from their peak, yet the index is still trading near its all-time highs. And that's because the cap-weighted index is pretty much ruled by the Apple, Microsoft, Google, Amazon family of stocks, right? You've got a tremendous amount of devastation going on below the surface. And unfortunately for Cathie Wood, she's a great example of exactly what's going on. Take a look at the performance differential between the NASDAQ and the ARK ETF, and it shows you exactly what's happening here. That's what's happening below the surface. So what we're talking about, we're talking about the Fed's going to impact the markets. It's already happening. It's just you don't see it yet because it's not happened to the generals, those leading the markets. But when that occurs, there's really nowhere for you to go to. And this is going to be an interesting point when we talk later on in this year about the value versus growth trade. One of the interesting dynamics about the market right now is if you take a look at the value sectors, real estate, utilities, consumer staples, energy, those make up a very, very small part of the overall markets. All your growth stocks, your technology stocks, your financials, those are your major market. Healthcare, those pretty much take up most of the S&P index. So when we see this rotation of value, it's going to rotate into some of the smallest sectors of the market, which means it won't be able to offset that decline that you may see in the technology names themselves. So in other words, if Apple, Microsoft, and Google give up the ghost, and I'm not saying they will, I'm not saying that at all, but if they do, trying to hide in the value sectors may not really help you that much.
All right. Wow. Well, okay. Great context. We're basically seeing a market that the pain is already being taken. As you said, it's just not being taken by the generals. It's being taken, we'll call them, by the infantry, right? By the smaller companies that are out there. All right. So, and really, you said kind of the big resolution that we're about to find out the answer to is you kind of gave two contradictory beliefs earlier here about the role of stimulus in propping up asset prices, or whether asset prices can continue to stay where they are without the stimulus if it gets pulled away. We're going to find out that answer to that question relatively quickly. So let's talk about what actually happened this week. So, markets down, I believe, over the course of the week. But what happened this week, just sort of market action wise, that caught you and your team's attention most?
Well, so again, if we go back and I actually did a video on this on Monday, talking about the market is repeating the same old pattern. And what that pattern was going back is that we have this kind of market rally, the market kind of stalls sideways, and then it kind of retraces back to the 50-day moving average, and then rallies again back to new highs. And it's just been a stair-step process over the last year. Well, going into early December, we talked about, the market was due to correct in early December because mutual funds had to distribute all their capital gains, exactly what we saw happen. On that pullback in the markets, we overweighted equities in our portfolio for the Santa rally. That worked out really well. And on Monday, because of the market had gotten back to overbought conditions, we were stretched above the 50-day moving average a good bit. We took off all those trading positions and raised cash in portfolios. Now, that all worked out well. And then on Wednesday, the Fed announces this more aggressive policy. Now, the market corrected. Now, if you watch CNBC or some of the mainstream media, it was markets in turmoil. Oh my gosh, everything's falling apart. Run for the hills, and I could just almost see people running around waving their arms and stuff. And that's not what happened. We just had a correction back to the 50-day moving average. And, so if you're a passive indexer, and this is a real key point that we're going to see come along this year, I think. If you're a passive indexer, the market pulled back to the 50-day moving average, no big deal. If you own a bunch of individual equities, particularly these high beta names, they got crushed. We saw companies like Asana and Adobe and others that were down 5, 6, 7, 8, 9, 12% in a day because of that idea that higher interest rates are going to start to impact profit margins, lack of liquidity, and this real idea that people are starting to kind of come around this idea we're going to have slower economic growth, which means these profit estimates that we're all banking on, these earnings estimates to help support these excessively high valuations, may not actually come to fruition. So all of a sudden, people are having to rethink how they're trading their portfolios, and we saw that start to really kind of rumble through the markets. But this idea of passive indexing is really important because, as we were talking about a minute ago about the generals and the infantry, at some point, if we start to see a market beginning to deteriorate on a regular basis and we begin to break real support, we're going to have a repeat of what we saw back in March of 2020. Because when all these people that are passively indexing in ETFs start selling those ETFs, that exacerbates the selling in all the underlying individual securities. So those are already getting sold. And now, again, I'm picking on ARK, and I really shouldn't, but it's a great example. It's just kind of where we are in the world. If all these stocks in the ARK ETF are already under pressure, if everybody and she's a big fund, right? She's, 12, 13, 14, I'm not sure how big her fund is now, but it's billions of dollars. If everybody starts liquidating that ARK ETF, that's going to put additional selling pressure on all those underlying stocks because she's got to sell those stocks in order to meet those redemptions. It's not free money. It's not just sitting out there. But this is going to lead to this idea that all of a sudden, market corrections aren't going to be like what you and I grew up with in 1999 or in 2008, where a bear market lasted 12, 18 months and you had, counter trend rallies and bounces even in a downtrending market. It's going to be a market where you're down 30, 40, 50% in the course of a couple of weeks because of this mass liquidation effect that occurs from the selling of passive investments. And when I always kind of chuckle, people tell me, they'll say, well, when the market starts to sell off, I'll get out of the markets. No, you won't. You won't have time. By the time you realize that the market is down 20, 30, 40, 50%, it'll be too late to sell. And that's what we saw happen in March of 2020. And that's what we'll see happen next time.
All right. Some really great points in there. And I really appreciate you sort of flagging the dynamic that these over concentrated positions the top 5, 6, FANG stocks. I don't know what the new acronym is, but you throw Microsoft in there now, right? They make up huge amounts of the major indices that we've talked about, but they are in so many mutual funds and ETFs out there, it's ridiculous. So if those things go down, they're taking just massive swaths of the entire market down with them. And then, of course, you talk about the dynamic of people who say, well, all right, look, it's getting hit, I want to sell out. Well, those forced redemptions add to the selling pressure. So you create this vicious cycle there. All right, so it sounds like this week, one of the things you're watching really closely is to see if the historic pattern of coming down to the 50 DMA and then bouncing, if it's just business as usual, we come down, we tap it, and then we go back off to the races. Or I assume if we break through it and continue down from here, that's maybe an important signal to you that, hey, things are different now. That the Fed is changing the rules here, and we got a different market than we had for the past year. Is that correct?
So now we're talking a little bit about portfolio management and the things and how we manage risk in portfolios. So if you take a look at our portfolio looks a lot like you were just talking about. Look, money is hiding in the most highly liquid stocks. I can own Apple and Microsoft and Google and Amazon in my portfolio because I can get out of that stock without dropping the stock, 4, 5, 6 points trying to get out of it. And one of the big problems with the market, and because of this passive indexing problem we alluded to earlier, is what's called a lack of liquidity. And the reason that you see a company like Asana or Adobe or Snowflake or Palantir or ET, you name the company, right? The reason you see these stocks open down 5, 6, 7% and finish the day off down 12% is because of this lack of liquidity. When these stocks are going up, there's plenty of buyers willing to buy it, and they've got to buy it at a higher price in order to find somebody to sell it to them. Let's not forget this is a market. For every buyer, there has to be a seller. Well, with a lot of these companies, there's the volume is so light in these, and there's so few shares outstanding that when they start to sell off, and the seller steps up and says, "Hey, I want to sell my shares," the buyer's going, "Yeah, I'll buy it from you, but it's going to be about 15% lower." And so prices have to come down. That's why you see these big drops. And the reason that hedge funds, mutual funds, pension funds, portfolio managers like me, we're hiding assets in companies like Apple, Microsoft, Google, because I don't have to worry about that. If the market opens down 5% one day, Apple's not going to be down 5% and maybe down 1%. I've got time to get out of it. In Asana or a Google, an Asana or a Snowflake or an Etsy might be down 15%. And that's the risk of portfolios. So when we start, so now to your question, our portfolio is built to withstand volatility, but it's also built to generate returns when markets are going up. When we start to see changes in dynamics, like I said earlier, the market was overbought and extended. We took off our trading positions. We raised cash. Why did we do that? Well, we were worried about the Fed minutes coming out and what they might say. So we wanted a little bit more hedge in our portfolios. Cash is a great hedge. I can't lose with cash. If I try to short the market, it's great, but I could be wrong. That's putting capital at risk. Cash, I've got no risk. So we raised some cash. Now we're watching that 50-day moving average. But if we break it, it's not the end of the world here because we broke it back in early December and we tested 2 standard deviations. Now this is a little bit technical mumbo jumbo stuff, so just bear with me.
That's okay. People are here to learn, so it's all good.
Well, so if we measure market movements in terms of what we call standard deviation, and we look at historical trends of standard deviation. So in December, the markets got oversold 2 standard deviations below their 50-day moving average, bounced, went right back up to an all-time high. So we've got a range that we can work with now. So if we come back down, break the 50-day moving average, as long as we stay within that bullish trend line that we've been building really since the October lows, there's really not too much to worry about. Right? We're going to have an opportunity actually to get the market oversold and to put some capital back to work. So that money, those shares of SPY and our trading positions that we sold earlier in the week, we now have that cash, we can put that back to work. If we start to break that long-term trend from last October, now we're talking about a different type of market. And this is where we're going to start talking about raising more cash, looking to get more defensive. One area that we've been buying into this week as well, we're buying bonds. buying long-dated treasury bonds. We had shortened our duration a good bit going into the Fed meetings and expecting rates to rise, which they've done that now. Bonds are very oversold here. And if we do get a risk off market, bonds will be risk on. In other words, money will move into treasury bonds for safety. Now, this is not a long-term bet on interest rates. This is a hedge bet on safety. Two things that happen with 10-year treasuries and longer duration treasury bonds when the Fed is tapering is rates fall rather dramatically. So as opposed to what people think, if you go back and look at the history, whenever the Fed has been hiking interest rates and slowing economic growth, bonds perform exceptionally well. They tend to go up right at the front end, but on longer duration, go back to 2018, you had a great return out of 10-year treasury bonds during that whole period where the Fed was hiking rates and tapering their balance sheet.
That's fascinating. And I think that's why, professionals like you are great people to leverage your knowledge, because I think that's kind of counterintuitive to the average sort of armchair observer here. Great. All right. Well, look, I want to ask you about, any trades that your organization made this week. I think you've already kind of just told us. You guys, took a bit off the table before the Fed meetings came out, the Fed minutes came out. You raised some cash. It sounds like you're kind of waiting here to see, are we going to remain within that traditional standard deviation range and still within the sort of bullish longer term trend? And if so, if stocks get oversold, you'll probably put that cash to work. But if not, obviously, you'll then say, hey, look, something's changed, and you'll change your strategy then, correct?
Yeah, exactly. Look, and talking about portfolio management, where people make mistakes is they tend to make big moves. And portfolio management is like a game of football. And in terms of, we always say football is a game of inches, right? If I can just make small gains, and keep making first downs, I can eventually get to the goal line. Trying to throw a Hail Mary every down, I might get lucky every now and then and have one caught and make a touchdown, but probably more often than not, either I'm going to be incomplete or get intercepted, one of the two.
Good analogy.
Same thing in managing money is that these are about small changes. We reduce exposure when things get overbought. We add exposure when things get oversold. And we also change where our allocation is. So last year we were more growth, we had value in our portfolio last year, but a little bit more growth. This year we're starting to seriously talk about swapping that balance around, having a bit more value in our portfolio and a little bit less on the growth side, because value should perform better in an environment where the Fed is hiking rates and lowering their balance sheet. So, people start to focus more on fundamentals. And we're seeing that occur right now. Stocks like Verizon, AT&T, Philip Morris, General Mills, they've had huge runs here over the last month or so. So people are kind of chasing that value trade. I do warn you, I caution you here about trying to chase it right now. That trade is very overbought on a short-term basis. And we've seen these kind of little moments of where value shows up and it's like, oh my gosh, the value trade's back, and then it's gone and everything's back to growth and you lose all your money. So, we want to make sure that value trade trend is going to be sticky. So we're already currently long, some value stocks in our portfolio, companies like ExxonMobil, and some of the energy stocks, which are value, kind of traditional value companies like CVS Health, which have very good fundamental quality to them. We own companies like Costco, some really boring companies like Procter & Gamble. Now, they've had huge runs and they're very overbought here, but if money continues to migrate in that area, we'll continue to look for more opportunities in that space.
All right, great. Well, real quick, as we begin to wrap things up here, as you look to next week, anything in particular that you're going to be monitoring next week, either announcement-wise or just, looking at the technicals?
Well, announcement-wise, we're pretty much through most of it. I mean, we got some basic economic data coming out. And, one thing to watch for in the economic data is we're already starting to see economic indicators like the ISM Services Index has peaked and rolled over. The manufacturing index has peaked and rolled over. We're starting to see a thaw out of a lot of the semiconductor supply lines. So a lot of this inflationary push that we saw from the supply chain disruption looks like, I'm not saying it is, but looks like we may be starting to kind of thaw that out a bit. Now that will start to lead back to more deflationary pressures in the economy on that side of the ledger. Wage pressure is still going to be inflationary, at least for a while. So we're kind of paying attention to that a little bit, but really when we get to next week, it's going to be really mostly about technical action of the markets on a daily or a weekly, even a monthly basis. Valuations, economics, those things really don't have a lot to do with the market. It's really mostly about market psychology. When you're talking about, months and months and years, that's where the fundamentals really start to play in a lot. And we're just not to that focus just yet. Everybody's very short-term focused right now.
All right, great. And then just making it personal for the viewers here, had we been having this conversation, a week or two ago, there would have been probably the seasonal recommendation of, hey, you might want to do some tax loss selling, right? We're here at the beginning of a new year. Anything that, today's viewers should be just considering about the particular timing of where we are in the year here, or anything else that's just sort of a general recommendation for people at this moment?
Yeah, well, first of all, yes, the answer is absolutely. This is the beginning of the new year. So, if you're long, one of the things I always find very fascinating when I talk to a client or a prospect, they'll go, well, I don't want to sell that stock because I don't want to pay taxes on it. There's a great way to not ever pay taxes on a stock is to turn it to a loser and then sell it.
Make it a loss.
Yeah, and trust me, I can't tell you how many times I've seen this in the past. I mean, huge gains just wind up going away. And look, if you take a look at a lot of the meme stocks that were last year that had people had huge gains in, they didn't want to sell them. Those are back in the red now. So you can sell them now at a loss and have no gains. But this is one time of the year where you can sell stuff now and not have to pay taxes on it until next year. So I would really go through my portfolio, look at things where if I own companies with big gains that are not really fundamentally very strong, don't have a lot of revenue growth, those type of things, but they've just been really kind of been chased by the markets. Doesn't mean sell all of it. This is the one thing that's always interesting to me. I say, hey, take some profits. Everybody goes, well, I'm going to sell it all. I'm going to sell the whole thing. No, just if you own, 5% of a company, trim it back to 3 or 4, whatever it was that you originally paid for it. And then, hold that cash or invest it somewhere else. And this is how we manage our portfolio. Every position in our portfolio has a weight to it. And when that position gets, out of tolerance, for instance, we've owned Ford forever, and that stock's had a huge run lately. And so we've been trimming it off into this rally. It doesn't mean we're selling Ford. It just means that we just keep bringing it back to our original 3% weight. And then when it grows to 4, we trim it back to 3. And when it grows to 4, we trim it back to 3. But we're capturing that cash. So if something does break, then we've benefited from some harvesting. And sometimes we'll have to have our conversation about how portfolio management's like gardening, because there's a really good analogy between tending a garden and your portfolio. But harvesting your vegetables out every now and then, you have to do that. Otherwise, everything just rots on the vine, right? And that's the real point about portfolio management, that it's so important that I think people forget about. And this is a great time of the year to do it because you can do it now. Think about where your portfolio needs to be risk-wise for the year. And whatever taxes that you incur right now, you've got the rest of the year to have some losses to offset those gains, and you don't have to pay taxes until next year. And if for some reason the government raises taxes on individuals, raises the capital gains rate or whatever it is, you're going to lock in a lower tax rate now as well.
All right, Lance. Well, that was wonderful. Next time, we'll go deep into your gardening analogy there. I think that's going to be really useful for a lot of people. And for folks watching, look, the ultimate purpose and mission of this channel and new programs like this is to help you make smarter decisions in terms of building your wealth and managing your portfolios. If you want to talk to a experienced, seasoned professional portfolio manager like Lance, just go to wealthion.com and you can set up a free consultation with one of our endorsed financial advisors. It really, folks, is just a public service. It's a chance for you to have, an experienced advisor like Lance and his team take a look at your personal financial situation, give you their best advice. And look, there's no obligation to work with them. These consultations are totally free. So if you want to take that insight and do it yourself, great. But I think for a lot of people watching this, you're hearing a lot of the expertise and the science that truly successful portfolio managers employ. And, we want to make sure that people are getting the best attention. Their portfolios are getting the best attention, because at the end of the day, we're all on this journey of trying to be good stewards of our personal wealth. Well, folks, I really hope you've enjoyed this program. If you've got any feedback in terms of what you liked, what you didn't like, what you'd like to see going forward in new iterations of this, just let us know in the comments section below. Lance, it's been a joy. I think I've really enjoyed this first inaugural program here. I'm really looking forward to doing this with you on a weekly basis, but thanks so much for joining us on this.
Absolutely. Love to do it. Can't wait till next week.
All right. Well, we'll see what next week's have in store. Thanks for watching, everybody.